Well, on behalf of the MIT Sloan School of Management and the MIT Finance Group, I want to welcome all of you to this third and final installment of the S. Donald Sussman Fellowship Lectures for 2012-2013. For those of you who are here for the first time, the S. Donald Sussman Fellowship is a prize that was created by friends of Donald Sussman, a well-known quantitative investor, hedge fund manager, and entrepreneur. And it was created to honor Donald's many accomplishments in his illustrious career, which is still ongoing. He's still an active investor in hedge funds. But over the years that Donald invested, he started up a number of very successful quantitative hedge fund managers. He was the first investor in David Shaw's D.E. Shaw. He was the first investor in James Simon's Renaissance Technologies. And over the years, he's given birth to many a quantitative hedge fund manager as part of his incubator, Paloma Partners. And so a few years ago, his friends decided to endow a prize in his honor to best exemplify the ethos of quantitative investing. This is a prize given by MIT every other year. And it's a prize of $100,000. So it's a pretty significant event. And last year, we named the inaugural S. Donald Sussman Fellow, who is Bob Litterman. And so Bob has given 2 wonderful lectures already you can find on the MIT Tech TV. And today, we're very fortunate that he's going to be giving a third lecture on the Quant liquidity crunch of 2007 and unrecognized crowded trade. Now, before I turn it over to Bob, I want to just say a few words about him. His accomplishments are many, so if I were to list them all, it would pretty much take up the entire time, and I won't do that. But I want to mention a few things that are notable. As many of you know, Bob got his PhD at the University of Minnesota in economics and was an assistant professor here in the economics department. And then he left to go to the Minneapolis Fed before moving to private sector industry at Goldman Sachs. And in his 23-year career at Goldman, he held a number of positions, including head of firm-wide risk management and global head of fixed income research and models, along with Fisher Black as the other co-head. And during that period of time, he wrote a number of very important papers, one of which he spoke about as part of the lectures, the Black-Litterman model for asset allocation and portfolio management. But I have to tell you that my introduction to Bob had nothing to do with industry or practice. It was as a graduate student, I actually used a statistical package known as RATS. RATS stands for Regression Analysis of Time Series. And it was written by Bob Litterman and a colleague, Tom Doan. It was an incredibly useful package for doing time series analysis, mainly because it was able to do a certain kind of calculation that was actually quite difficult to do in any other package, a calculation known as Bayesian vector autoregressions. Now, this seems like a psychological disorder to many of you, I'm sure. But in fact, it was actually quite an important tool, both for macroeconomists and, it turns out, for financial economists. Because when Bob got to Goldman Sachs, one of the things he did was to help them build their risk management infrastructure using tools along the same lines. And so as a result, over the years, I've actually known Bob and refer to him as Vector Bob. That's his a trade name, I guess. But he's here today to talk about his time when he was head of quantitative investment strategies at Goldman Sachs and managing through a very, very difficult time. So please join me in welcoming Bob Litterman.
Well, thank you, Andy, for that very nice introduction. So today I'm basically going to tell a story about the quant liquidity crunch. I was there, and so it's kind of a personal story. As a bit of a disclaimer, I will tell you there's no original research behind this. There's been many studies of what happened, and so I'll tell you my take on it. But I remember very well when I recognized what was going on. It was about 10 a.m. on August 6th, 2007, 6 years ago, a little over 6 years ago. And when I saw what was going on, I realized my life was going to change. And indeed it did. What was happening was basically, what happens when someone yells fire in a crowded theater. And everyone ran for the exits, and there I was very big, very fat, and sitting in the middle with no way of escaping. So one interesting issue is, why we didn't recognize it ahead of time, and I'll talk a little bit about that. Another interesting issue is that I would say the basic model of what was going on was actually written several years earlier, and I'll refer to that. So it was a very prescient paper in the Journal of Finance. I wish I had seen it ahead of time and understood it, although the reality is, unless I had seen it many months ahead of time, there would have been nothing I could do. And in fact, even if I'd seen it many months ahead of time, it would be kind of like, oh, I better get out of here quietly while no one notices, which would have been very difficult. So just the attempt to avoid what inevitably happened might have created it sooner. So, but just to give you kind of a framework here, Goldman Sachs had a quantitative group that I was head of that was a very successful business. We thought we probably, who knows what our market cap was, but it was a very important business to Goldman Sachs. We were one of the bigger quantitative houses in the business. We had several businesses. The most well-known was a hedge fund called the Global Alpha Fund, but that's not really part of it. That was basically a macro fund. And this is really a story about quant equity. So we had another hedge fund, the Global Equity Opportunities Fund, that was very much focused on getting exposure to these quantitative factors throughout the world, not just in the United States. And it was market neutral. We hedged out all the risks we could. And the issue that we had with that fund was it was really, it had a very high Sharpe ratio, but you needed a lot of leverage to get risk. And so we ran it at approximately, we tried to run it at 10% risk, and often we're not hitting that, so we were increasing the leverage in order to try and hit our volatility target. And I personally tried to get as much exposure as I could. I borrowed money so that I could increase my exposure to this fund. And if you were to take, say, my human capital, my compensation, as well as my direct exposure to the fund, I was certainly by far the most exposed to this fund of any of the investors. And so going up until through June of 2007, everything looked like it was going great. The fund was up 15%, an annualized volatility of 10%, so it was doing quite well. The economy, not so much, and we will go through sort of what the backdrop was, but there was a lot of concern about the mortgage market, and I was at one time head of risk management at Goldman Sachs. I gave up that position in '94, so this is much later, but I still sat on Goldman's risk committee, which met every week. And throughout the spring and summer of 2007, there was a mantra that we heard about not taking a lot of risks, avoiding crowded trades, and staying close to home. And so even though I sat there and week after week heard about crowded trades, it never occurred to me that I might be sitting on a crowded trade, which indeed was the case. Now, what happened? Well, there have been many discussions of what happened. I like to refer to Andy's paper, which was written within, about 4 weeks after the event. Professor Lowe is pretty amazing about getting this stuff done. And in fact, these are some basically quotes from the paper. During the week of August 6, quantitative long-short equity hedge funds experienced unprecedented losses. A rapid unwinding of quantitative equity market-neutral portfolios started by a sudden liquidation, possibly due to margin calls or a risk reduction. Initial losses then put pressure on a broader set of long-short and long-only equity funds, causing further losses by triggering stop-loss and deleveraging policies. Significant rebound of these strategies occurred on August 10th. Now, in the paper that Andy wrote, there were a lot of qualifications. We don't know, we're not sure, this is what it looks like. But basically, all of the major conclusions and the work that Andy did turned out to be basically true. I don't know anything in that paper, a lot of which was basically speculation at the time, has stood up the test of time. So that's basically what happened. Now, I'm not going to talk a lot about quantitative asset management. I think probably you all know what we basically try to do, but we try and find these factors that forecast returns. And then we try to create portfolios that have exposure to those factors, long the things that look like they're going to outperform and short the things that look like they're going to underperform. Or you can do it relative to a benchmark. But let's say in the context of the Global Equity Opportunities Hedge Fund at the center of this story, it was market neutral. It had long-short portfolios, over 1,000 positions, well over 1,000 positions in individual stocks in countries around the world. We tried to hedge out every risk factor we could, certainly the market itself, but any other risk factors like size or liquidity or volatility or factors that were not designed to create returns, we hedged out, and then we tried to get as large of exposures as we could to the factors that we could see and that would drive returns. So that's basically what we tried to do. Now, we didn't think of it as a trade for perhaps obvious reasons. We thought of this as a business. We'd been doing this for years, and basically the business was you have an existing portfolio that you own at the beginning of the day. There's new information that came out yesterday. Your computers process that information, look at transactions costs, look at what's changed, and tell you what to trade on a given day. And it's very hard to go from the inputs to the outputs without the computer. There's no direct mapping. And so you think of these updating of the portfolios as an evolution of your exposures to the factors, and you hold your positions typically for long times. Your average holding period is certainly measured in months. Now, we worried about risk, obviously, but as you'll see, we weren't prepared. This is a graph that shows for 4 different regions weekly returns, 5-day standardized returns in the US, UK, Europe, and Japan. And so what you see in the blue is the historical 5-day returns measured in standard deviations. And then you see the red lines, which are what happened basically over the course of this event, which was, the event itself was basically about 4 days. So it looks like one line, but what that really is a set of losses followed by a very sharp rebound. And if you look at, say, the US alone, something like 30 standard deviations, and then you take the other countries and put them together, and you realize this was a very, very unprecedented event if you just look at it in terms of the magnitude relative to previous exposures. Another way of looking at how unusual it is to think about how much of the return of any given equity on average was explained by quantitative factors. And you can see, again, here we have about 6 years worth of data. And what this data is the R squared of a regression each day of equity price moves on the estimated quant factor returns of that day. And the quant factors typically explain very little of the movement of stocks until this particular week when that jumped up to something like 30%. Now, let me tell you how I recognized what was going on. As we went through July, so I told you our fund was up 15% through June. Well, the month of July was a terrible month. It was probably the worst month we'd ever experienced. It was down 15% during that month alone, which for a 10% annualized vol fund, it's a big loss. But it hadn't happened on any one day. It was very sort of strange because day after day we were seeing losses of, half a standard deviation. And in fact, I think of the 21 business days, I think our fund lost on 19 of 21 days. So it really felt strange. And the week, I guess it was August 1st, we had our risk committee meeting. The firm-wide risk meeting was every Wednesday. That Wednesday, the week before the event, I actually talked to the head of equity trading, and I said, is there something going on, some quant fund liquidating or something? It sure feels like something. And he said he didn't know of anything. So I thought, well, okay. That Monday, I came in and by 10 o'clock in the morning, the fund was down another 5 standard deviations. That's really when the event started, was that Monday morning. And my first reaction was, whew, that's good, because I've been looking at this the whole month of July and couldn't figure out what was going on. We just seemed like something really weird was going on. So at least I'll be able to tell, because something that big, it's going to hit me over the head. So I loaded up all these positions that we had into a spreadsheet, along with the real-time data, to see what were the big losses. And usually when you have a big loss like that, there's some big position you have where the stock got killed. Well, I sorted on the losses, I looked at it, and there was nothing there. And I thought, oh, that's not good. Because clearly what was driving this was something endogenous, something, and 5 standard deviations. It was obvious at that point that there was a major liquidation, probably not just one anymore. And so what do? You're sitting there on billions and billions of, if you try and get out, it's, so even though I recognized what was going on, the space was melting down. It wasn't clear there was, what do you do at that point? It's too late. So we hoped something would happen, it would stop. It just kept getting worse and worse and worse. So that was the situation we found ourselves in. Now, if we go back, take a little bit longer perspective, this is a graph of the VIX. And you can see the arrow shows where we were at the time of the Quant event. This was early on. You can see volatilities had really come down, and we were just starting to see. I remember very well the first time I heard about the potential for a financial crisis. It was actually in December of '06. I was at a hedge fund, a dinner for hedge fund managers sponsored by Goldman, and one of the managers there, I don't even know who it was, came up to me. He knew I had been the head of risk management at Goldman. He says, "Do you think subprime is going to take down the economy?" I didn't know what he was talking about. I thought, subprime? I didn't even know what that was, to be honest. I didn't deal with mortgages. I thought, subprime, take down the economy? I tried not to look too stupid, but I'm sure he looked at me like, this guy doesn't know, that's not good. And throughout that spring and summer, as I say, we started to get more and more nervous. You started to see, well, I think the next slide, but before I leave this slide, you see this was nothing when the Quant, we were the first wave of the tsunami that didn't hit till a year later. It started with housing. Housing prices really peaked in 2005. I remember seeing a talk by Bob Schiller up at Yale on the housing bubble. And he had very convincing evidence that housing was, in a major bubble in 2005. It's got to collapse by all measures of valuation relative to rents, income, and so on. This was crazy valuations. But most of us sat there and thought, well, doesn't sound good, but I don't know what it means to me. I don't have any exposure to housing price bubbles. Well, we were wrong about that. Here you can see the meltdown in mortgages, which basically started in January and started with subprime, and then slowly built up over the course of that spring and summer, and then started to hit investment grade mortgages just a few months before the Quant meltdown, which again is indicated by that blue bar. There were spillovers to other markets, spillovers to money markets, spillover to credit, spillover right during the same week that the Quants melted down, the asset-backed commercial paper market melted down. What you can see here, this is outstanding in terms of positions. So basically, there was no new asset-backed commercial paper issued after that event. And in fact, there was a Fed research paper talking about the liquidity crunch in August 2007. They weren't talking about the quants. They were talking about the other sectors. And there was a German bank, IKB, I think it was, that required a liquidity injection. And the Fed and others did inject liquidity that week, not because of quant equity, but because of what was going on in commercial paper. And here you can see credit derivatives. Again, the spreads just started to widen in that spring, and then got much, much wider later. But obviously that had happened a little bit before the quant event. And here you see LIBOR Treasury spreads. And here the event is actually right during this period. So Treasuries and Fed funds rates decline dramatically as the Fed injects liquidity, one of its first injections, and LIBOR, representing the risk of banks, move the other direction. So that was going on. Interestingly, these spillovers, and you saw this throughout the financial crisis, they didn't all happen at the same time. And here we're showing the subprime, which headed down. This is through July. The carry trade started going down, and then this is quant equity, US. So you can kind of see the bad month in July. These are daily observations through July. And then this is the, I guess, Monday, Tuesday, Wednesday, Thursday, Friday. No, I got that wrong. This is Friday, Monday, Tuesday, Wednesday, Thursday, and then back up on Friday of the week that it happened. Now, so the event really got started on Monday. On Wednesday, in the morning, so I guess that would be, so Tuesday night. So we were right here when I went into the firm-wide risk meeting, and normally I didn't say much at that meeting. I was in the asset management division, so I still participated in the firm's discussion, but I usually didn't have much to say. That day, I said, well, you know, there's something very strange going on. The quant space is melting down. We had a much longer discussion, but I remember saying, you know, the weirdest thing about it is it's just in the US. It hasn't spilled over. Well, it turned out I was out of touch with what had happened a few hours earlier in Japan. Wednesday in Japan, it spilled over. And so you can see that here, whoops, in the green, you know, Monday, Tuesday, nothing happened. Wednesday, it spilled over. And that spillover into Tokyo really meant that who knew where it was going to stop. This was clearly an out of control panic. And so Goldman Sachs really took over managing the crisis at that point. And I would have to say they did a very good job. Within 48 hours, they had arranged for a liquidity injection. In fact, less than 48 hours. So they became aware of it Wednesday morning. Over the course of the next 2 days, it was pretty amazing because they had, you know, I've never been in a situation where you have senior management, lawyers, and all kinds of people descend on your business, basically take it over and structure a bailout, and that took 2 days. And they arranged for a $3 billion injection with all the legal niceties, 6-month lockup, blah, 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 within, you know, by the end of business Thursday. And indeed, I would argue, who knows the reality, but I think it's very likely that news of that, although there was a very tight blackout on information, they basically said, don't answer your phones. And if you talk to anyone, don't say anything. Nonetheless, they did have to go to outside investors to try and get liquidity. And they told investors they couldn't, you know, this was all private information or whatever. But whatever happened, Thursday night, they got the injection, put it together for investment as of Friday's close. And basically, the turnaround came Friday morning. And you can see that on the timeline. In fact, this is, as I think I mentioned, a lot of these charts are not mine. So this one, and hopefully they're all labeled, comes from a paper called When Everyone Runs for the Exit by Lasse Peterson. And this is his reconstruction of the event using minute-by-minute data. And it looks very much like the real-time P&L. I don't have the real-time P&L from our fund, but my memory serves me, it looked very much like this. So I think this is an accurate representation. And you can see basically where it bottomed out. This is Friday morning, the open. It just came back very strongly, but Monday, Tuesday, Wednesday, Thursday, it just kept going down. Now, this is a very interesting price path for a financial asset because it doesn't look at all like a random walk. In fact, something like 95% of the 10-minute intervals all move in the same direction. So what might explain this? Well, as I mentioned, there's a paper by two economists, Brunermeyer and Peterson, 2005 Journal of Finance, and they suggest that when you have a crowded trade, you should expect to see something like the pattern of prices represented here by the red line. So sure enough, it looks very much like this. Now, their paper, I've given this paper a couple of times, and my friends tell me, well, they have some, they're not so sure about the assumptions that drive this, and we'll talk about that a little bit. I'm not saying they had exactly this event in mind, but it's a liquidity crunch, and it certainly leads to the right-looking path for pricing. Now, what was their paper? It was called Predatory Trading. Now, predatory trading sounds like, someone taking advantage of someone else. And indeed, that's kind of how they talk about it. Trading that induces or exploits the need of other investors to reduce their positions. So basically, it's a crowded trade. Think of the London whale trade that you've all heard about. You got someone who's got a big position, and other people realize they're going to have to get out of that position. Well, what do? You don't sit idly by. If you have the ability, you say, let me get in front of that. If you can't get in front, you at least trade at the same time as let's say it's a long position. As you have to sell, you're going to drive the price down. So if I can sell where the price is today, knowing it's going to go down, and then buy it back before it goes up, I can profit from this person's need to get out. So if one trader needs to sell, others also sell and subsequently buy back the asset. I've highlighted the word the asset because that's one of the, like I said, I hadn't seen this paper, but had I seen it, first of all, I wouldn't have recognized it had anything to do with our space. I certainly had heard about crowded trades and avoiding them. Now, why didn't I realize we were in a crowded trade? Because we had over 1,000 positions. None of those positions were particularly large relative to the underlying trading in that asset. And you think of an asset price being driven by this trading. Well, we thought we were a small part of a lot of liquidity for lots of different assets, not one asset. But in any case, when you realize that someone's going to have to get out of a position, you try and get out first. This leads to overshooting of whatever the fundamental value is. There is no liquidity because everyone wants to get out of the way. They know that liquidity is needed. And as these guys suggest, you can actually profit by causing something like this to happen. And that's why they call it predatory trading. Now, I don't think there was a predator, or I don't think someone caused this intentionally in the quant space. We'll talk about what I think caused it. But once it's recognized, if you have the ability to take advantage of it, you certainly can. And there very well may have been people who had the ability to take advantage of what was going on during that week. And the crisis can spread across traders and across markets, as we saw from the US after 2 days into Japan. Now, the idea of a liquidity crunch is not new. In 2002, Bernardo and Welch talked about liquidity runs and crises are not caused by liquidity shocks per se, but by the fear of a future liquidity shock. Jim Cramer, Brunermeyer and Pedersen quote Jim Cramer, a former Goldman guy who now talks about stocks on TV. You probably know that, Jim Cramer. When you smell blood in the water, you become a shark. When you know that one of your number is in trouble, you try to figure out what he owns and you start shorting those stocks. There's many historical examples. The 1987 stock market crash was induced by portfolio insurance strategies. It's the same basic idea. A lot of people knew that there was a lot of portfolio insurance, which meant that when the market went down, you had to sell the market. And so that's, again, like a crowded trade. You know there's going to be demand for liquidity, and you want to get in front of that. LTCM liquidation was another similar example, and it continues today. The credit derivatives trades of the London Whale are another perfect example of this. So it's well known, it happens. What's going on? Well, usually trading is induced by fundamental information. Something looks cheap, so you buy it. You push it back toward fundamental value. However, if you know something about future order flow, you know that someone's going to have to sell this asset, then that creates destabilizing price behavior as you try and get in front of that sale to sell at a higher price than what you know will be the price in the future. And you're pushing, or can be pushing, the price itself away from whatever fundamental value is. The Brunemeyer and Pedersen paper considers many cases, but the one I want to focus on is what they call endogenous instability, which is to say it's not really one trader causing another one to have a problem, but rather the market itself becomes unstable. So the basic idea, though, just to go through it, and this is a graph from their paper, is let's say you have a distressed trader and a predatory trader. The distressed trader, for whatever reason, has to sell a position. And so these are the positions on the vertical axis with time on the horizontal axis. So the trader discovers he's got to sell and knows there's limited liquidity. That's part of the model. And one of the things that you might criticize this model for is there's a lot of sort of ad hoc assumptions that drive the amount of liquidity that's available. And if there were no barriers to liquidity, you'd just get movement to fundamental value, and you wouldn't get this time path of prices that we talked about. But in fact, if you set up a limitation to the provision of liquidity, then it takes time to get out of the position, and during that time, a predator will trade either in front of you or with you until the point where you no longer need to access liquidity, at which point that predator will buy back the position, and on average, they'll be buying it back at a cheaper price. So where does this is the price dynamics. So while everyone is selling, the price is obviously going down, and if you're a predatory trader, where do you stop trading? Well, at this point, since you know the price is going to continue going down because the distressed seller has to keep selling, you're going to sell here and then buy back, kind of on average down here. So this is sort of the last point where you trade, and then you start buying back as the price goes up. So that's kind of where that price path comes from. Now, the endogenous instability is created because you build a model where a trader has to liquidate if their wealth falls below a certain level. They call it W star. So the wealth itself is basically the price times the position, and then you have other wealth. So two things can cause a liquidation. One is just a shock to other wealth, but the other, and especially if you have a leveraged portfolio, is that if you think other people are going to have to sell, that's going to cause the prices to move against you, and that can bring you below that W star, at which point you would have to sell. So you can have exogenous shocks that lead to endogenous distress. The exogenous shock in this case is pretty clearly what was going on in credit markets and mortgages and so on. Traders fear that the behavior of other distressed sellers may erode their wealth even further. Potential future liquidation implies it's optimal to sell in front of the selling pressures of other strategic traders, and liquidations may be induced by the expectation of liquidation by others. So that's all kind of the story about endogenous panic, and this graph is really, I thought, a great picture of what the quant space looked like. In fact, what you have here on the vertical axis are various wealth levels. If one, and so it's a little bit hokey, but if one other fund goes, this is sort of everyone in their model, everyone has the same wealth, and if one trader gets into distress, everyone below this level of wealth would have to sell. If two, then A would be in trouble. If three, B's in trouble, and so on. So this is a stable market because no one has to sell. Okay, but If one trader up here has to sell, so there's an exogenous shock, say, to D, well, then A, B, and C may be in a position where they don't know whether or not anyone else is going to have to sell, so they start selling, and pretty soon the thing falls apart. Now, you could almost put names on this. You could say, well, that's BGI, and that's Goldman Sachs, and that's AQR, and then you could say, well, there's some of these smaller, highly levered, multi-strategy hedge funds, and Paul Tudor Jones. So, yeah, this was a space that was stable before the shock, and then melted down as everyone feared that everyone else would have to sell. There was one high-frequency. I won't mention names, but high-frequency trader in this space that called us up about 2 o'clock that afternoon, Monday afternoon, said, "Are you guys selling?" Because, he had just gotten out of his positions at that point and wanted to know. There was a lot of discussion, who's causing this? And, well, my view is it was probably multi-strategy hedge funds. There were a lot of them. Andy's shaking his head. I mean, I don't think anyone knows for sure, but there were, one of the danger signs was one of our guys left Goldman and went to work for SAC Capital. And that was unusual because he was a quant, and SAC Capital was, an equity fundamental shop. So it seemed a little strange that they would be hiring quant to build a quant. But that's exactly what was going on throughout that space, which is multi-strategy hedge funds were basically allocating capital to different types of strategies, credit, mortgages, quant, et cetera, et cetera. For them, it absolutely was a trade. I'll put some money into quant. It seems like a good place, easy to lever up a few $1 billion with a couple of quants who know this business. Another sign of danger was I was giving a talk in Kuala Lumpur at a central bank conference. And during a break, I went into a bookshop, and there on the business shelf was a nice thick book on quantitative equity management with a diskette in the back. So, you could do it on your own computer. And I should have realized at that point that this was a crowded space. And to be honest, I spent the last year before this giving a talk called "How Big is Too Big?" And it was my speculation on, how big could one fund be. We had closed our funds, by the way, including this Global Equity Opportunities Fund, at least a year earlier, thinking, you can only be so big. But we were sort of thinking in normal times when your concern is your trading going to move prices against you, and are you still going to be able to capture alpha? And we knew the space was growing around us, but we just didn't see what was going on. So, but these multi-strategy hedge funds, as you can imagine, were in a bit of distress during that spring as mortgages were melting down, credit was melting down, a lot less liquidity, and they were trying to raise cash and lower risk, and quant equity was viewed as, number one, sort of a black box that they didn't necessarily understand, and a good place to raise cash because of high margin in that market and reduce risk. And I think those guys all talk to each other. So maybe as they started unwinding these positions and seeing each other unwind and talking to each other, they realized much faster than I did that this was a dangerous space to be in. And then as July became a disastrous month, I'm sure they all said, well, this is not good, let's get out. What happened? Well, a prisoner's dilemma developed. Everyone kind of recognized that getting out slowly, and I think that's what was going on in July. You don't have as much market impact, so you take your time. But as things got worse and worse, and people started being afraid that others would liquidate, and in particular, afraid that a big, highly levered hedge fund like something being run by Goldman Sachs might have to liquidate, well, I better get out first. I'm sure there were a lot of people worried about what we were going to do. And if others rushed to liquidate, I better get out first. So there was a panic unwinding that developed on that Monday. Liquidity dried up. Normally, liquidity was provided by stat arb strategies, high frequency strategies. So these quantitative strategies are very low frequency. They kind of hold their positions for months. But we knew that there were others who, high frequency traders, who kind of came at the space from a different direction. It started out with sort of pairs trading and then statistical arbitrage. And the idea was sort of to identify the patterns created by sort of lower frequency liquidity demanders and take advantage of that. Of course, these were smart guys, and they realized that they could actually predict what we would be doing by looking at the factors that would drive our demands for liquidity. And so these high frequency stat arb guys would look at the same information we would look at, and they would just operate on it much more quickly, take out the first little bit and then sell it to us. We knew that was going on, but we thought that's fine. They're liquidity suppliers, we're liquidity demanders, they're taking a little bit of a cut, and we're finding liquidity net is much greater, which it was. Our transactions costs throughout this period when stat arb was developing were going lower and lower and lower per dollar invested. What we hadn't counted on or thought about is that they won't be there when you need us, when we need them. See, it was very easy for them, and they did, to say, basically, this isn't working. These factors that I've been getting in front of are all going the wrong way. Very easy for them to say, we're out. And I think that's what they did. Now, it's very possible that they said, oh, this is going the other way, let me get in front of that. So there may have been some, what you might call predation. In fact, I would guess there was. But I don't know. That's, who knows? They would know. But from our point of view, basically liquidity dried up, trying to get out of the position we needed to get out of. And we did try and sell, some during that week, but there was a lot of price pressure if you tried to sell these positions. So we basically knew that we had, in that Global Equity Opportunities Fund, something like 24 billion long and 24 billion short on an underlying capital that started the week at something like 6 billion. But as you can imagine, during the week, it was, our leverage was going up as our losses, I think at the worst point, we were down about 33%. Maybe there was 4 billion of capital left. And in fact, we were rapidly running into the issue of being able to post margin. So that's basically what happened. You had a prisoner's dilemma, positive feedback, unstable equilibrium, and explosive dynamics as we got closer and closer. So what ends the stampede? Well, supply and demand. As prices move further away from fundamental values, higher risk is offset by higher expected returns, and liquidity returns as new sources of capital seek to participate. Now, the reality is it's not that easy to participate in this market unless you have all the technology set up to create these portfolios. It is true that someone in Kuala Lumpur could set it up, but they couldn't do it overnight. They would have to, and you can imagine those who have gone to the trouble to develop that technology are already invested. And investors who understand quant, to whom it's not a black box, have already made a decision about being invested or not. So there's not a lot of new sources of capital that you can quickly deploy. So that was one of the problems that meant that you'd have to get very far from fundamental value. The other thing that you might ask is it clear where fundamental value is? And this is not so obvious. If you think about, say, a standard measure of value, so we might take 1,000 stocks and line them up according to this metric and say, well, this one relative to this metric, price to book, let's say, looks very cheap. This one looks very rich, okay? And so on average, we expect these to, if these were the cheap ones, to have positive returns, these to have negative returns. But as the quants all start taking advantage of this, as you can imagine, you're going to start pushing those residuals, call them, from that metric toward the metric. but they shouldn't all be at the metric because there's all this other idiosyncratic reasons why companies are valued as they are. So you might imagine that all the capital flowing into the space caused the valuations not only to go to sort of closer to fair value, but maybe much past that. And even though these still look cheap and these still look rich, as soon as that pressure to push them toward that goes away, maybe the equilibrium is actually further away. So it's not so clear where fundamental value is. It's not on the line, for sure. So the interesting question for Goldman and the rest of us was, where is it going to hit bottom? You know, and so I say Goldman engineered this liquidity injection less than 48 hours after they were called in. And I would say those of us in the Quant group had no clue what it would take to stop the stampede. Gary Cohn, who's the second in command under Lloyd at Goldman now and was at that time, he basically came onto our floor, took charge, and decided, all right, this is what it's going to take, and was very confident that this would be, now who knows, you know, maybe he knew, maybe he had good cards and he knew where other people were and how much demand was left, and or maybe he was a good poker player. But in any case, he very confidently went to the market and said, we think this is a great opportunity. We're going to invest. If you'd like to invest alongside of us, you know, we can give you this opportunity. I think their plan was to raise a little bit more than they were able to, but in any case, they had a total amount, and Goldman made up the difference. And they came in Friday at the close, which, if you remember that chart, was not the low by any means. Most of the rebound occurred actually during the day Friday. This is how the quant factors performed from Friday through the end of the month. I mean, it was a major rebound. But the interesting question is, you know, because I was an investor in the fund, I was in effect forced to sell my positions at the Friday close to the new capital. You know, was I treated fairly? Is an interesting question. I would say I was treated very fairly. And the initial rebound for those who got in at the Friday close was about 13%. But by the time they were able to exit 6 months later, that had become a 6% return on the capital invested. So you can imagine going to an investor on that Thursday evening saying there's this stampede trying to get out. We think it's a good time to get in. No guarantee it's a good time to get in, but we think it is. You know, what would it take to induce you? I think it would be more than a hoped for 6%. So I think they did okay. Certainly probably disappointing from their point of view, but for those of us who were forced to sell, it wasn't a bad outcome. I can tell you on Thursday, if you'd said you can get out at these prices, I would have said great, because it was unclear whether it was going from down 33 to 0 or down 100, you know. It's, if you had to give those positions to the prime broker to liquidate, you would not have had anything left. So that's basically, that's basically the story. What are the lessons learned? Well, pretty obvious lessons. Spillovers are likely across unrelated markets. A crowded trade is not what you think of as a trade, but could be any strategy. Liquidity is context dependent, so when you need him or her the most, your friendly liquidity supplier will quickly become a predator. A crowded space with one or more large, highly levered portfolios is especially fragile. And crowding can grow slowly, with a tipping point in expected returns determined by actual and expected flows of capital, not levels of capital in the space. So I would say that last one is one that I was particularly guilty of missing when I was thinking about how big is too big. I was very much thinking about the level invested in the space. And when I was watching that 15% return that I got for the first half of that year, I was very convinced that was coming from our ability to find opportunities in the space and harvest alpha, as opposed to riding the tailwind of new flows coming in And this is a very common phenomenon. In fact, there was a book written about it where you have a good idea. Portfolio insurance would be a good example of this. You have a good idea, people see it, they copy it, a lot of capital flows in. While all that capital is flowing in, it's working fine. Then there's a shift, it stops flowing. All of a sudden, let's get out first. And it's not a pretty picture. So you make this implicit assumption. My assumption was, yeah, this can't keep going on forever. Quant can't succeed and have Sharpe ratios of 1.5 forever. But it'll erode slowly. I'll have plenty of time to see as capital flows into the space that Sharpe ratios are slowly going down. Well, they didn't slowly go down, and it's because it was a flow issue, not a stock issue. So here's a selected set of references about the Quant event. This last one, the crisis of crowding, Quant copycats ugly models and the new crash normal, is all about this pattern of good idea, copied, does well until it doesn't, and then crash. So I'm happy to take questions. I think we have about 5 more minutes.
Questions? So if you were setting this up again, knowing that this kind of event happens, what would you put in place to be able to manage the business through it?
Well, good question. We have set up again, many of us, and our average holding period now is about 4 days, so that tells you something about how we would do it differently. We're not doing anything in individual equities. We're operating in macro markets that are very liquid, and we're much smaller. I would say one of the big issues is you can't be as big as we thought we could be, and another perhaps obvious lesson is you can't be as transparent as your clients would like you. If you have a good idea, don't tell everyone about it. We wrote a book about it, and we joked in the book that we'll tell you everything about how the process works and risk management, but we're not going to tell you what our factors are. And it was kind of a joke because we knew that everyone knew, our factors were the same factors that academics had been writing about for years. We thought that we had, marginally better measures of value or this or that, and we fooled ourselves because if you looked at the correlation of our portfolios with other quant portfolios, it was very low because there's so much noise. And each portfolio, depending on when it got started, depending on, because there's transactions costs, so you're really never at an optimal position. You're always evolving toward so the things you're trading depend a lot on initial conditions and size and so on. So we thought this was such a complex space that, the low correlations, we didn't have to worry so much. But of course, in this event, everyone got killed. Now, if you looked at the different quant factors during the event, you could see very clearly which ones were well known and which ones weren't, which is something that's not so easy to determine otherwise. But it was like a light was turned on, and you knew, oh, well, value, momentum, those are all crowded. This thing over here that, we came up with, that wasn't so crowded. And actually, I would say we were very focused on getting new factors into our models. But those new factors didn't always work as well. Remember, there's a lot of tailwind going on in the well-known factors during this period. So they're performing very well. You didn't have a lot of motivation to move elsewhere. But unknown, so investing in strategies and factors that are not well known, and obviously not publicizing what they are, those are some of the important lessons learned. Yeah.
You were leveraged, heavily invested in your own strategy in 2007. Would you do the same thing again to another strategy, or would you diversify?
Well, I was heavily invested. I wasn't that heavily invested. So let's say if that had gone down to zero, I wouldn't have been bankrupted, but it would have been very painful. So yeah, I was probably too heavily invested in my own, but nowhere near what a typical, entrepreneur who funds his own business is. I would say when I went into it, my thinking was I can't get enough exposure to this. And now my view would be, I want to be a little more diversified, yeah.
Last question?
Well, if you weren't levered at all, you wouldn't have to do anything, just wait.
That's right.
And you're talking about shrinking your trading time frame to weeks, days, minutes. Isn't sort of the contrarian would to go longer term, just buy and hold and ride the bumps in these?
Well, first of all, you're absolutely right. It's really the leverage that creates the problem.
Right.
Although, if you were a long-only quant fund, you got hurt during this event. And let's say these factors never came back completely. So, and it's kind of what you might expect if you say there was too much capital in the space. The space basically, outflows were huge. And no one knows, I think, very well for sure, but if you look at Goldman Sachs or BGI or some of the other big quant invests, they're like a tenth or less of what they were. So I would say that, and this is sort of typical. We saw it in '94 as well. When there's a big period of negative performance, it takes 3 or 4 years before the capital sort of eventually flows out. So long only didn't mean you didn't get hurt. You underperformed for sure over this period. If you think that quant factors are going to continue to perform, and I don't see any reason why they wouldn't, although the performance that we saw before the event is probably not indicative of what one can expect going forward. So you had this really good performance, then you had the event, then you had many years of outflows and really poor performance, and more volatile performance. So I would say what you should expect from quant equity factors going forward is much lower Sharpe ratios than you had. You now have to recognize, there was a long debate about, is this a is this a risk premium or is this alpha? And, I have to be on the side of alpha. But today it's for sure a risk premium. These factors are now risk factors. There's no question about it going forward. So you're getting paid perhaps a risk premium for those factors, but it's nowhere near what we thought it was. And that's fine. That's one strategy. The other strategy is to be, more, we're not very high frequency. We're not competing to be the fastest. But what our current hedge fund is kind of in that intermediate, higher frequency, but not super high frequency space. And we think that's a nice, well, not really. It's not really that good. You don't want to think about it. Very difficult. Very crowded already.
It's we could stay here and talk with Bob for hours. There's a tremendous amount of wisdom that he's imparted. And I want to conclude by saying that it's very easy to get people to talk about their successes. And God knows Bob has been incredibly successful in his career, made a great deal of money for Goldman, for his investors. And it's not that easy to talk about challenges. And we really appreciate your willingness to come here and tell us about the period. It's easy for academics to write about it, but not so easy for somebody who's in literally the middle of it to be able to come talk about it. And I think there's tremendous wisdom in what Bob has shared with us today for all of us. And I hope you'll watch the video and read the papers that Bob decided and go over all of the things he said, because I think there are many lessons that we can draw from it. I also want to say in closing that in addition to exemplifying the ethos of quantitative investing that Donald Sussman has outlined in his career, Bob has done a great deal for changing the way people think about quant investing in terms of his dedication to risk management, his focus on responsible investing, and most recently, his activities in environmental issues. He's on the board of the World Wildlife Fund, but more importantly, he's actually focused his many talents on the notion of using economics and incentives to deal with climate change. And Bob has very generously declined to take the prize for this award, and he's donated it back to MIT to support research on climate change. And if you take a look at some of the earlier lectures that he's given both here and elsewhere on YouTube and Tech TV, you can find out about that as well. So please join me in thanking Bob Litterman.